One thing that's allowed us to grow and be successful is we've had the foresight and are always willing to adapt and grow and build infrastructure to do what is necessary to execute the plan.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in.
All right, thanks everybody for joining the live webinar today, and would like to also thank Zach Haptonstall for joining the meeting today. We're really looking forward to diving into real estate investing basics. Obviously, the emphasis here is on passive investing and specifically in multifamily versus maybe some other alternative options. So again, really appreciate you being here with us today. Just a quick agenda for those that are on the call today. We're going to jump through a little quick sponsor background on both Zach and myself for those that don't already personally know us. We're going to talk about passive syndication investing, exactly what syndication investing is, why passive, why multifamily, why value add, those types of things. We're also going to jump into the investing thesis and what Starting Point Capital and Rise48 have learned over the number of years that we've been and both the active and the passive side of real estate ownership. We're going to then talk a little bit about the track record of the sponsor and why that matters. Okay. Then we'll finish up talking a little bit more about the new Charlotte market expansion and that particular target market and why we like that area. So with that said, we can transition on to the next slide. I'll go ahead and transition this part over to you, Zach.
Yeah, thanks so much, Jeremy. And I just saw my partner Bikram popped in as like a celebrity guest over here. So thanks, Bick. I know you're going to be on this, so this is an honor. But yeah, no, thanks so much, Jeremy, for putting this on. We've been partnering with Jeremy now for a while and his Starting Point Capital firm. So I'm Zach Haptonstall. I'm the CEO and co-founder of Rise48 Equity. And so at Rise48, we are a value add multifamily private equity firm. So this is all we do is buy existing multifamily deals, go in there and renovate the interiors and exteriors to increase the value and get that profit margin for you, the investor. And so since we've started, we've purchased 51 different assets, over $2 billion of transactions, nearly 10,000 units. We have offices in Phoenix, Arizona, Dallas, Texas, and Charlotte, North Carolina. We have our own property management company, our own construction management company. We're completely vertically integrated, which we'll talk about here shortly. We have over 250 plus full-time W-2 employees on full healthcare benefits. So we've really, built the entire organization around executing this value add business plan. And we just stay laser focused on this one niche. So we don't do development of new apartments. We don't do self-storage or mobile home parks or anything like that. We just want to really be experts in what we do. And that's a little bit of a background on myself and the company.
Yeah, no, appreciate that, Zach. A little bit about myself for those that don't know me personally. Jeremy DYER, Starting Point Capital. I really got my real estate investing journey started back in 2012. My wife and I had a particular interest in real estate investing. I wanted to find a way to diversify my portfolio a little bit outside of Wall Street and into Main Street. And so my wife and I decided after watching an HGTV episode on an evening night while our kids were young that we decided we wanted to fix and flip houses. Okay, so back in 2012, we started buying houses. Fortunately, I was blessed in my personal professional job to have enough liquidity to be able to acquire distressed single-family homes with cash. That helped us from a competitive advantage perspective because we were coming in with no contingencies. We were able to acquire those assets. And typically it would take us about 3, 4, 5, 6 months to fully renovate those single family homes and ultimately flip them on to the next buyer. The challenge that we had back in 2012 and kind of moving through 2015 is my wife and I during that time decided to double down on kids. Okay. So we went from 2 kids to 4 kids. My older boys were active in year-round sports, everything. I was coaching their teams. And I looked at my wife one day and I said, listen, in order to scale our single family home business, we're going to really have to throw gasoline on this business. So we're going to have to go from flipping 2, 3, 4 houses to 20, 30, 40, houses a year in order to really scale it up. The challenge was, in order for me to be able to do that, it was going to come at the sacrifice of not spending time with my family, being a good husband, being a good father, right? Serving my local community. So it was really in 2015 that we decided to instead start passively investing in real estate syndication. If you had asked me in 2015 what the word syndication meant, I wouldn't have been able to tell you with a good answer. I knew the Green Bay Packers were syndicated, but outside of that, I didn't really know what that meant, what that word meant. And so in 2015, we learned about a sponsor that happened to live in the Twin Cities, Minneapolis, St. Paul area of Minnesota, that had been doing it for a number of years. And I would say we used the shotgun approach. Okay. We held our breath, we plugged our nose, we sent in our wire transfer, kind of hoping for the best. I waited for that strategy then to fully realize itself before I made my second investment into real estate as a limited partner, because I wanted to prove the strategy worked, right? And it did. Okay. So from that point then until today, my wife and I are now active in 29 different real estate investment properties, purely as limited partner investors, 6 different operators, a dozen different market locations. We also invest in other asset classes outside of the primary asset class we're going to talk about today, and that's multifamily. So we also invest in others like, for example, assisted living, self-storage, flex office, retail, et cetera. And so what we learned during the course of that time as limited partner investors is I can really, over the course of about a 5 to 10 year period, I can really start to change my wealth building trajectory. This is not a get rich quick scheme. Okay. I didn't start investing as a passive real estate investor, knowing that I was going to hit a home run and a grand slam, by year 1, year 2. Okay. But now that we're in 29 deals, we can see how these deals compound on one another. And what it has really done for my wife and I specifically is it has allowed us to replace the full dependence on the W-2. Okay. My wife does not work outside the home. She homeschools our kids. So I am the breadwinner and the single earner in our family, right? And so what passive investing in real estate has allowed us to do is to not have to be so fully dependent on that active W-2 income that I make through my day job. And it's really allowed us also to diversify into other different investments that are not so tied to and correlated with Wall Street investing. Okay. So now 2 years ago, we start telling friends, family, and colleagues about this type of an investment strategy, merely to just let them know this is what we're doing. And if you're interested, why don't you make an investment too? And so 2 years ago, Starting Point Capital was formed purely as an education platform to educate friends, family, colleagues, those that are in my professional network about the benefits of passive real estate investing. What I learned 2 years ago is that I have some leverage. Okay. The leverage that I have is with the sponsor. Okay. So number one, we got educated. We learned the business. We understood it. Okay. That's a huge part of investing passively into real estate is you've got to truly understand the business and why the relationship with the sponsor is of utmost importance. So we got educated. We learned the business. We grinded it out for those first few investments to really learn the business. And then I was in a position whereby I could bring other investors along with me. And what I learned is that by doing that, by creating this community of investors to partner with me on these opportunities, we could leverage with the sponsor a better preferred return. We could leverage with the sponsor a better investor split. We could leverage out additional splits in the waterfall or the waterfall hurdle above a certain IRR projection. So what that really allows us to do now is it allows us to go to our investor network, give them a better return, on their investment than what they would get, quite frankly, if they went retail. And the truth is that most busy professionals, most high net worth individuals don't have the amount of time that we do to fully, vet the sponsor, which is what it's all about. So sorry for the long-winded answer there, Zach, but we can roll on to the next.
No, that was really helpful. Yeah, thanks, Jeremy, for all of that.
Yeah. And so some of these things that I already had kind of talked about, I kind of gave my own personal bio and background, but, really when it comes down to syndication investing, it's just group investing, right? The lead sponsor has a targeted property identified that they've underwrote according to their own, underwriting criteria, right? They've stress tested the deal, hopefully. And now they're looking to, after they go under contract, they're looking for a couple of things. Number one, they're looking for bank debt. Right. And number two, they're looking for other limited partners to invest alongside them so that they can ultimately take down that targeted property. And so that's what syndication investing is it's just purely group investing, right? Where limited partners come together, they co-invest alongside the sponsor into the opportunity. When it comes to kind of the three, legs of syndication investing, for us personally, it's really, why passive versus active, why multifamily versus some other asset class, and why value add as opposed to, ground up development, a build to rent or something like that. On the passive side, really for us, it came down to, our time commitment, right? And not wanting to materially be involved in things like evicting tenants, right? Swinging hammers on weekends, right? Dealing with termites and trash, being a landlord and all the different, stresses and time commitments that come into place there. And what we learned is that with our own personal money, we were able to achieve very similar and sometimes even greater returns being passive investors versus doing it actively. So, really a lot of it comes down to that on the passive side. Both passive and active investing allow for the investor to achieve things like appreciation, whether it be organic or forced through a value add, business plan. Like when we were single family home, fix and flippers, we knew that the market probably wasn't going to appreciate a great deal over a 3 to 6 month hold period, right? But we were looking to force that appreciation through a value add renovation strategy. And that's really what we do, now as investors, where we're looking for targeted properties to invest alongside sponsors that also have that same value add mindset. Why multifamily? I'm personally a big fan of diversification. Okay. I think that investors should diversify in different market locations with different sponsors, with different asset classes, even different, classes of assets, whether that be a B plus, class asset or a C or an A, et cetera. So I really think that it's important to have a balanced approach when it comes to, investing. But when it comes to brand new investors that have personally not invested as a passive investor or as a limited partner into a real estate syndication before, my recommendation is that they always make that first investment into a multifamily opportunity. I also always encourage investors to consider investing the minimum. Oftentimes, I have investors that will get real excited about this type of an approach and an investing strategy, and they'll tell me, Jeremy, I'm all in. I'm going to self-direct my, $500,000 IRA into your next deal. And I tell them, hold on, wait a second, right? Rather than investing everything into one deal or one opportunity, maybe let's take a look at the next 5 or the next 10 different opportunities. Maybe they're in different market locations. Maybe the business plans are different, right? Let's diversify the approach over multiple different, asset classes. Why value add? The challenge sometimes with like a build to rent opportunity where you're investing in ground up development, number one, usually those types of investments don't produce a year 1 or a year 2 depreciation tax benefit lost to the investor, which can be really impactful for investors when it comes to being able to defer, those tax gains on investments or not have to pay capital gains taxes on those distributions or the equity profit split that you receive when the deal ultimately goes full cycle. So I'm a big fan of the kind of existing assets that were built in maybe the 1970s, 80s, 90s, where there's a value add component, where the majority of the interiors of those units are classic. They need to be renovated. Maybe there's a high amount of deferred maintenance, or maybe there is a significant amount of loss to lease in place, where we can really push those rents up to what that local market would be able to withstand. And a lot of that really comes down to, who the sponsor is, right? Who is the actual lead sponsor or sponsors that are implementing the value add business plan? And let's talk about the team that they're surrounded with, right? There are folks that are currently syndicating apartment buildings through a value add strategy that might be a team of 2. Okay. They might be a team of 10. Maybe they're even a team of 25, or maybe they're a team of over 200, right? So these are really important things that investors need to be aware of when they're considering investing in multifamily opportunities. And that is, it really all comes down to, what the overall business plan is. And are you comfortable and confident that the team that's going to be managing the value add business plan is capable of pulling it off? Now we'll go ahead and hand it over to you, Zach. I think you might be on mute, so if we can maybe talk through a little bit more on the investing thesis and maybe some things that you've learned as the founder and CEO of Rise48.
Yeah, thanks so much, Jeremy. Really, really well said. And yeah, I mean, like Jeremy said, is that, the whole concept of syndication is that basically, there's a dynamic between what's called a GP, which is a general partner, and an LP, which is a limited partner. And the GP is raising money from the limited partner. So limited partner are passive, you're pooling your money together, and the GP is effectively doing all of the work. And they are what's called the syndicator. And as Jeremy mentioned, there's a lot of groups out there, hundreds of different syndication groups, and they're not all created equally, because a lot of sponsors, which is another term for syndicator or operator, I would say most of them are using what's called third-party property management. Okay, which when you're starting out, that's typically what you should do. Meaning that, if I want to go buy a deal, I am going to raise money from investors to buy an apartment building, and we're going to hire a third-party company that will manage that asset. And by managing the asset, that means that the on-site property manager, the maintenance staff, the leasing are all, a third-party company. And that's what we did initially at Rise48. Okay, because you can listen to all these podcasts and you learn about financial freedom, and they say, oh, all you do is you buy the deal and you slap a third-party management company on there and you sit back and collect the cash. And that's what we thought we could do, frankly. But as we started to scale, we realized very quickly we cannot have a third-party company controlling our assets. We have to have full control over staffing. If I don't like somebody, I need to be able to fire them immediately. I need to be able to change bonus and incentive structures to properly align the interests of the staff with the business plan. I want to make sure my staffing ratios are strong. I want to make sure I have the best benefits in the industry. And so long story short, we started our own property management company called Rise48 Communities. And when you have your own property management company and you're controlling all components of the operations, that's what's called vertically integrated. So we are vertically integrated. We have Rise48 Equity, which is our investment company. Rise48 Communities is our property management company. And then we have Rise48 Construction, which is our construction management company. And so we are basically managing every single step of the process. So all of the on-site maintenance, leasing, managers, all that full-time staff that's working 40, 50 hours a week on the property are our W-2 employees. We have full control over that staffing. And then we also control the construction management component, where my guys are walking these units 40 hours a week, making sure everything is staying on schedule, on budget. And so, having that property management, that construction management control is critical, because like Jeremy said, the benefit of investing in value add, which we'll go into more, is that you can get better returns. You can really insulate yourself towards down economies because you can force appreciation. But there is inherent execution risk, which means that you have to actually be able to renovate these units on schedule and on budget, okay, and execute a plan. And so, anyways, I don't want to, go too deep in here. Jeremy told me to go through this slide quickly, and then we'll do a Q&A. But basically, we have full control. Another big component is that we control our supply chain completely. Okay, so what does that mean? All of the materials that we use for the interior renovations, we're buying them directly wholesale from an overseas manufacturer at fixed pricing. We're getting significant discounts, and we control the supply chain 100%. Okay, we are not relying on materials from like a third-party vendor where they can mark it up. we are getting significant discounts, and we've renovated thousands and thousands of units the last several years, and we're coming in under budget on average and consistently because we control the supply chain. And so, strategically, the reasons that we are in Phoenix, Dallas, and Charlotte, North Carolina is because we have that same supply chain, same cost, same logistics process in all of those markets. So that is a big component, especially post-COVID, when many of you on the call, regardless of the industry, know that obviously inflation has been a challenge, but just the availability of materials has been an issue across the country, and we have not had any issues with supplies being available, costs, things like that. Maximize growth through collaborative efforts. This really comes down to building a true organization with staffing ratios and real infrastructure. Okay, so we have a very comprehensive built-out org chart, and we make sure that we're maintaining staffing ratios operationally for all these assets. Okay, and so we're very strategic about that, and this goes to every department. Okay, we've built out all of our departments, as far as investor relations, accounting, financial planning analysis, marketing, all these different departments. And so, we honestly don't even like to be labeled a syndicator, because it kind of has like a negative connotation, because anybody could be running a syndication from their couch. We have a true, private equity company that we've built out. And that's obviously important to have collaboration with your team. And then, transparent reporting. We have institutional level reporting where we've actually created our own investor portal. We provide very detailed executive summaries to every investor every month, which shows you all the key metrics, budgeted to actuals. And then we upload the entire financial package for that investment into your portal every single month. And what does that mean? That means you have full access to all the bank statements, the mortgage statements, the balance sheet, the general ledger. You can literally see every single accounting entry that we've made. In addition to that, our company is corporately audited by one of the big four accounting firms. It's something that we've done voluntarily, just to have more credibility. All the assets that we've purchased since beginning of 2023 until now, those books are all audited by a big four accounting firm. And we've spent that money, at the corporate level out of pocket, six figures, just to have that higher level of compliance. And so these are some of the things that we really kind of take pride in.
Yeah, no, I appreciate that, Zach. And I'd really like to kind of take this part of the presentation really to kind of be tough on the sponsor. One of the things that a lot of our investors look to me for is to really have that relationship with the sponsor. It's really difficult for limited partner investors to have as close of a relationship with the lead sponsor, ultimately because oftentimes the lead sponsor has thousands and thousands of different investors that are partnering with them. So I know our investors really trust in the sponsor because they're really first trusting in us, right? To have done our own due diligence, right? To have really, worked with, the lead sponsor, ask the tough questions of the sponsor. So at this point, I'd like to really spend a little bit of a Q&A session, if you don't mind, having me ask you some questions that I think would provide some value to our audience. Okay.
Yeah, no, absolutely. Sounds good.
So, kind of one of the main questions that I like to typically ask right out of the gates, why is it the B class asset specifically, that's kind of in the typical buy box, right? Your B class asset, your B class neighborhood, oftentimes referred to as, workforce housing, where the majority of the demographic lives. Why is it that specific asset class, that you've really targeted and you would say is really the type of asset class that gives you the biggest competitive advantage?
Yeah, it's a great question, Jeremy. It's something we put a lot of thought into. So we have Bikron on the call here as well, but Bikron, myself, and another partner, Robert, we started the company, and Bikron and I really run the company, day to day. And when we were first getting into this, we researched all types of different real estate investment classes. Okay, we looked at self-storage, mobile home parks, we looked at development, and then we really were digging into this, value add B class workforce housing type of investing. And what we wanted to do is we wanted to look historically, and we said, hey, we want to build a massive dominant company that will be here for decades to come. And so we don't need to be hitting home runs every deal. We want something that is sustainable, okay, and we can really build over the long term. And when we looked at historical data, especially the 2008, 2009 recession, we saw that when that recession hit, people lose their single family homes, they can't afford them. They cannot afford Class A luxury apartments because those rents are so high, and there's a small amount of demographic that can afford them. And when those people are losing their homes and they can't afford Class A apartments, they're trickling down into this B class type of affordable housing. Okay, so it truly is where the majority of the demographic lives. Okay, so so we're not buying like slumlord properties by any means. There is obviously we would call that like D class assets, but we're buying clean, safe communities. And to give you an idea, we have almost 6,000 units in Phoenix. We have almost 3,000 units in Dallas right now. We've sold about 1,500 units. Our average rent right now is around $1,300 a month. Okay. And that's after we've renovated these units. And so, there's a couple different reasons we like that B class is that it's more insulated during downturns because it is affordable. And so when you look historically, these B class assets stay highly occupied and they're cash flowing even during downturns because everybody needs a place to live. Like during COVID, we actually saw significant growth. We actually benefited from COVID, believe it or not. And it did really well. So that's one big thing is just to be conservative from the beginning and be in that more insulated type of space. And the other reason it's more conservative is that you kind of touched base on this, Jeremy, is that when you buy a brand new Class A luxury apartment, I'll be honest, it's a lot sexier than our properties. Okay. It just looks nicer. You have all the modern amenities, you have the newer construction. It looks really nice. But the problem is that those rents are at the ceiling. Okay. Those rents are at least $2,500, $3,500 a month. You cannot push those rents anymore. Okay. So those are more of what we call a long-term yield play, meaning that you need to hold that deal 7 to 10 years and you are truly banking on organic rent growth, that the market is going to climb over the next several years. And that's where you're going to get the appreciation, right? Where with us, we are specifically trying to find properties that the rents are below market right now relative to what other properties are achieving in that immediate area. And so we're looking for deals that have not only value add ups, I mean that I can renovate the units and increase the rent up to what other renovated units are achieving right now. But we're looking for deals that have operational upside. Okay, maybe a lot of these deals, they're being run by a mom and pop, or they maybe have, an absentee owner that has a third party management company that just is asleep at the wheel, not being held accountable. They're not pushing rents like they should, not optimizing their expenses. And so we're trying to find deals that we can increase that value. Because to give people an idea, if you own a home and the house across the street sells for a big number, that's increased the value of your home, right? Because that's considered a comp or a comparable. Well, these properties are not necessarily valued that way. Okay. They are valued like businesses. They are valued based on how much money are they producing every year, and they will sell on a multiple of that revenue. Okay, just like a business. And so if I can go in there and I can say, hey, there's conservatively $150 of rent on this 200 unit asset. Every single unit's $150 below market because the seller's not renovating or not pushing the rents. If I can go in there and spend X amount of dollars, increase the rents, then I've drastically increased the value of that property by millions of dollars. And I've created value. I've created a profit margin to then sell or refinance to get that profit for my investors. And so we think that this B class workforce space is more insulated because it's affordable because the bulk of the population lives. But the last couple of years, as interest rates have skyrocketed and organic rent growth has gone zero or negative in most of the markets, most of the major markets, if you're not renovating units, your rents are going backwards, right? And so I always like to give this example. In 2023, the organic rent growth in Phoenix was negative 4%. So if you were not renovating, your rents were going backwards by 4%. Well, we renovated over 1,900 units, nearly 2,000 units. Our average rental increase was $453 a unit. And that's because we were buying deals. And what we do, this, Jeremy, but for those who haven't seen what we do is we will buy a deal that has the original white appliances, original flooring, countertops, cabinets from the 1980s, and we will gut the entire unit. And we do brand new vinyl plank flooring, real quartz countertops, stainless steel appliances, brand new cabinets, LED lighting. So we're creating a Class A luxury interior scope, but it's in this workforce housing type of product, which allows us to increase the rents, which increases the value of the asset and gets us that profit margin. So it's twofold. It's that, we can basically be more insulated because it's more affordable. We can force appreciation rather than having to rely on organic appreciation. And then when times are good, when interest rates are low, organic rent growth is strong, you can get explosive returns, right? Because these rents are going up. And so that's why we just realized, okay, this is the space that we want to be in.
Yeah, no, I appreciate that. It really reminds me of when we were, renovating single family homes. We had the option to rent out those homes, and maybe, net $200-300 in profit, per month, right? But if you're doing that over the course of an entire apartment community with 200 to 300 units, right, and you're forcing those rents $200 to $300, per unit after renovations, that increase in net operating income trades at a multiple, right? It doesn't really trade at a multiple if you're doing it, in the single family space. It's really just strictly based upon what the local comps are in that neighborhood in terms of what you're going to be able to get for that unit if you sell. So really
Yep.
appreciate that. You brought up a number of things, and I would just want to kind of, unpack a few of the things that you said, just so our audience, has a little bit more of a grasp and an understanding of what you're saying. You do talk about creating value add. So definitely understand where the value add is in the renovations, but that type of a strategy can be risky, right? It can be risky as the sponsor transitions residents from one unit to another. Oftentimes it's been said that in some cases there's a full blood replacement, by the time, you're done, fully renovating, the asset. So how does the sponsor, or how does Rise48 specifically mitigate the risks associated with things like increasing labor costs, supply costs, evicting tenants, concessions, burning off, loss to lease, et cetera?
Yeah, it's a great question, Jeremy. And yeah, I mean, that's the thing, is that it sounds easy in theory, right? Okay, we're going to buy this deal, we're going to renovate the units, jack up the rents, we're going to sell it. Well, for those of you who have ever, maybe some of you have flipped a house, but even if you've had like contractors work on your own house, you've probably experienced that it's a pain in the butt because everything takes longer than it's supposed to. It costs more. And so there is execution risk of making sure that everything is being renovated on schedule and on time. And, if you've ever flipped a house, you know how stressful that is. Well, imagine renovating 200, 250 units a month. That's what we were doing last year at the peak when we were really busy. We've done thousands of units, like I said, over the last several years. So there's a lot of infrastructure that you have to create to execute and do it consistently. And like I was saying, when we started, we had no plans of starting a property management company or a construction company. We did it by necessity. And it wasn't because any of the deals failed. It's because literally the first deal that we bought, it was Bickron, Robert, myself, and a couple others. We had no passive investors. We all put in big chunks of our own money. It was a 36 unit, $3.5 million deal in Central Phoenix. And we wanted to learn how to execute a value add plan ourselves, with our own cash, before we brought in passive investors. And right out of the gates, the property management company was supposed to be doing the construction management, and the labor and the vendors were not staying on schedule, on budget. I'm out at the property chewing out vendors, and I had never done that before. And we realized as we started to scale, we're like, you know what? If we're going to be, to be what we want to be the best company in the industry, this is an absolute necessity. And so I think, one thing that's allowed us to grow and be successful is we've had the foresight and are always willing to adapt and grow and build infrastructure to do what is necessary to execute the plan, right? And so, to answer your question, you have to have solid property management. You have to have a control of your supply chain, because the units that we're renovating, to give you guys an idea, to that very high level scope that I mentioned, we're spending about $16,500 roughly all in for labor and materials. If you go to Home Depot or Lowe's and you try to do that same scope, you're going to be around $29,000 to $30,000 easily. Okay, so we're doing almost half of that. And it's because with our supplier, we have contracts in place where we sign a contract with them when we acquire the asset, and we are paying a flat price per unit for materials for the lifetime of that asset. Okay, it doesn't matter if it's a 1-bedroom, 2-bedroom, or 3-bedroom. We say we're paying you this flat number, and they'll make more money on some units than others, but we're giving them so much volume that it makes sense for them. And then we do the construction management, which means my staff is sourcing, bidding out, and managing vendors like roofers, plumbers, electricians. So we're using third parties, but our guys are on site 40 hours a week watching all of that. And then we're also using third-party labor to do the in-unit renovations. But our guys, like our employees on the construction side, are supervising these guys and making sure everything is staying on schedule, on budget. And so what we've had to do, Jeremy, in order to make sure that we have consistent ordering, delivering of materials, and then actually getting renovations done is that we have we basically have a supply coordinator who receives the shipments at the property, makes sure everything is supposed to be there before we sign off, and we have liability on those materials. And then we have construction coordinators who are walking these units 40 hours a week, making sure that third-party labor is staying on schedule, on budget. And we require that all of the vendors have to use our materials. When we first started, third-party construction companies, they will provide the materials. They make most of their profit margin by marking up materials. So all these guys are they have the commercial membership at Home Depot or Lowe's, and this is all they're doing. They're going and buying materials. And we saw this in 2020 was that they were literally competing with each other because they got the last set of appliances at Lowe's. And then like there's a backlog because people can't get materials, and we're like, we can't have this. We feel vulnerable to these macro supply chain issues. So we told these guys, we said, hey, going forward, you're using our materials. And at first they get all pissed off. They're like, hey, no, that's how we make our money. And we said, listen, we'll pay you more than what you normally charge for labor, but you're using our materials. We just said, what do you need to make? Like all in. And so we have contracts with all of our construction companies that we sign at the beginning of the acquisition. We're paying them a flat price per unit for labor for every single unit for the lifetime of the project. So I mentioned that today it's like 16.5 all in. Deals that we were buying in 2021 at the time, it was like 11.5 to 12.5 all in. We're still paying that right now for deals that we're renovating that we bought in 2021 because I have fixed pricing on my materials with my supplier and I have fixed pricing with my labor. And so when I go to buy a new deal, if expenses have risen in the last few years, well, we are getting bids and budgeting for what it costs right now to renovate that unit. And if that deal still pencils and makes sense, we know we're locking that in for the lifetime of the project. So that has what has given us a major advantage because so many groups have gotten in trouble that they budget X and then a year later, inflation shot up. There's supply chain issues. And so that causes things to increase because you don't have a lot of availability of materials and it completely blows their construction budget. And so we've been able to insulate ourselves because we just learned from these earlier experiences that we had to, create this infrastructure. So that's been one big thing to kind of insulate the execution risk.
Yeah, no, I appreciate that, Zach. I really appreciate your insight there. I've kind of always, let investors know that when it comes to real estate investing, at least on the operation side of the business plan, it's equivalent to saying birds fly, fish swim, and real estate falls apart. It's just what happens. Okay. Everything is not always the easy street. Okay, there's always challenges, whether it's, weather related or operations related or supply chain or labor, right? There's always something. And that's why it always comes back to, ultimately who's the jockey that's riding the horse. I've had conversations with hundreds, if not 1,000 investors, at this point, in the early growth of Starting Point Capital. And there's a number of different investing realities that limited partner passive investors often overlook. Okay. And I'd like to share a few of those with the audience before I jump into the next question. It's important for investors to understand that success is not guaranteed. Okay. Deals can deviate from what the original plan is. Okay. Well, that's also true when it comes to your index fund. Okay. Or your 401k balance, or the Tesla or Facebook stock that you invest into, right? So the same challenges exist in Wall Street as also exist on Main Street. I also like to share that the pro forma is essentially an educated guess and not a concrete prediction. The truth is that none of us have a crystal ball, okay? I didn't predict the global financial crisis in 08 and 09. I didn't predict 9/11. I didn't predict COVID. I didn't predict that the Federal Reserve Bank was going to increase the Fed funds rate by 550 basis points over a 16-month period. And I don't know too many experts that predicted it either, right? In fact, most of the time the experts get it wrong anyways. So it's important for people to really understand, that that's why it all comes down to the sponsor. Other things that I like to share with investors is, really managing operations is often more challenging than the acquisition itself. Certainly, I know Rise48 specifically underwrites 100 deals before they take one down, right? There's a tremendous amount of work that goes into underwriting, 100 properties, taking one under contract, and then all the due diligence that has to occur, thereafter, not just at the property level, but also at the financial level. I'm sure that you guys have plenty of stories of skeletons that you find, literally in the closet, or, in the financials. So really important that people, understand that this is all about, betting on the sponsor's ability to execute the value add business plan. And it's all about the asset being managed over the course of that, investment hold period. I also like to, encourage investors to really, stress the sponsor and say, hey, are you acquiring this asset just to keep the lights on? The truth is that the sponsor makes an acquisition fee. The sponsor makes an asset under management fee, which is usually, hopefully, within what the market would determine is fair, right, for investors. But beyond that, it's important that the sponsor's primary profit that they make on the deal is tied to the execution of that business plan and the ultimate return, to the investors. And I also like to just simply share with investors that, real estate is not a shortcut to wealth. I kind of brought that up before. This is not a get rich quick, investment strategy, right? It requires time and effort on behalf of the passive investor. So I like to refer to myself really as being an active passive investor, in the sense that it's still my responsibility to educate myself, right? Listen to podcasts, read books, talk to others that are, currently in the space. It's important for me to do my own due diligence, on the investment opportunity, and actually look at the underwriting, look at the business plan, stress test the assumptions that the sponsor's making to determine whether or not I feel as though it's a conservative investment. And certainly, the passive investor also at the end of the, deal cycle, so to speak, when it's time for exit, the limited partner has the decision to make then too, right? At the time of disposition, right? When the deal goes full cycle, you have some decisions to make, right? Are you going to pull your cash and profit off of the table? Maybe execute a lazy 1031 exchange strategy by doing that and reinvesting that money into another deal? Or are you going to execute a full, 1031 exchange strategy, right? So there's a number of different decisions that need to be made. And so it's really important that limited partner passive investors, take ownership of the investment strategy. Don't just simply rely just on what Jeremy's telling you or just what Zach is telling you. Actually take our advice and continue to get educated and ask questions. So the next question that I've got for you, Zach, that I'd really like to unpack a little bit more is we talk about distress, right? We talk about, operational distress. We talk about financial distress. From an operations perspective, it's, back in my single family home flipping days, it was pretty clear that the homeowner was distressed from an operations perspective, or even perhaps financial, when looking at maybe the yard hasn't been cut in 6 weeks, maybe there's, maple trees growing out of the gutters, right? It's pretty easy to kind of determine whether or not that there's some distress there. In the multifamily space, though, I think we're also currently experiencing some more than normal financial distress as a direct result of the higher interest rates and the costs associated with the sponsor's ability to make those debt payments. So I'd like to talk specifically about, your maybe comment on valuations being down currently right now between 20 to 30% in some markets from some distressed sellers. And how does a sponsor really determine if they're securing the asset at a competitive basis? And what scenarios would cause an operator to become distressed?
Yeah, it's a good question, Jeremy. I mean, the biggest things are people that took highly leveraged loans, like 85% or more, loans, and then interest rates shoot up. They're feeling a lot of pain right now. A big part of it we talked about is people that cannot execute their business plans, like people that did not renovate the units and increase the NOI and force the appreciation. Well, when your debt service shoots up and you have not forced appreciation and increased NOI to kind of keep up with that, then you have a real problem. And when you give people an idea, you touched on this earlier, Jeremy, like really nobody saw interest rates skyrocketing like that. You've got some of the biggest institutions in the world that have foreclosed on properties recently because things just changed so quickly and shot up so quickly. And so, I think it's been, if you took lower leverage loans, if you bought longer term interest rate caps, if you have infrastructure to really execute these business plans and force the appreciation and increase the rents and the revenue in spite of all the headwinds that we've seen, such as organic rent growth going to zero or negative, all this new supply of apartments that have come online, then those are the groups that are kind of making it through. And so, we've bought a lot of distressed deals from groups, and we actually have not sold a deal since July of 2022. So in beginning of 2022, we were still selling deals that we had bought, in like from 2019 to 2021, and we were hitting home runs. So we sold 5 deals from January to July of 2022. Okay. And we were hitting really strong returns. But as many of you know, in March of 22, the Fed did their first interest rate hike. And then, like Jeremy said, it increased, 550 basis points in a short amount of time, which was the most drastic and aggressive interest rate hike in over 40 years, since the 1980s. And so with commercial real estate, values are very sensitive and influenced to interest rates. So when interest rates go up, values go down. Okay. And so this is why many of you have seen, office space has just been getting crushed. Obviously, COVID had a big impact on it, but the interest rates going up so much, like a lot of people don't think office space will come back. And office was always the darling of commercial real estate. Multifamily has taken that spot now. It's the #1 asset class where private equity is investing in for real estate. But multifamily has been a lot more resilient than office space, just because the fundamentals of people actually needing a place to live have not changed a lot. Like, it's performing well in that sense. I can tell you, like, we're seeing, across our portfolio, very high occupancy, high collections. But in the short term, when rates go up, values go down. And so for us personally, it makes no sense to sell any deals right now. Because if I sell a deal right now, I'm basically giving a discount to a buyer. So you mentioned the stock market, Jeremy. Think like a stock. You want to buy low, sell high, right? Same thing for real estate. And so when rates are high, values are down. So we think, from our perspective, this is the best time to buy these multifamily deals in probably the last at least 12 to 15 years, because we're buying deals right now that are 20 to 30% lower purchase price than just 18, 24 months ago. But the net operating income on these deals, like the revenue and the money it's producing, is like 15 to 30% higher than it was 2 years ago. Think about that. The property's producing more money now than it was 2 years ago, but we're buying it on a much lower basis. It's all because of interest rates. Okay. So when interest rates do cut, and who knows when that will be, next 24, 36 months, that causes cap rates to go down and values will go up very quickly. So there's an inverse relationship between interest rates and values. And so to answer your question, like, what causes distress? It's groups that have loan maturities coming up. Their balloon payment on their loan is coming up. They didn't execute the plan. They did not increase the value. So they have to sell the deal. They're forced to sell the deal. And many people are selling at a loss right now, or they're selling at today's values, which are down. They're compressed because of interest rates. And so most people are not selling unless they have to. And we've told investors, depending what happens with interest rates, we don't think we're going to sell any deals until maybe second half of 25 or sometime in 2026 at the earliest. And that's assuming there are significant interest rate cuts. So we're in acquisition mode. We're not in disposition mode, just because of where we're at in the market. And so it's really the inability to execute your business plan and increase the NOI, increase the revenue at the property. It's taking highly leveraged loans. It's having, loan maturities come up that you can't refinance out of. You can't extend those loans out. We've had, to give you guys some insight, we have lenders who are happy with us, who have reached out to us recently asking, hey, would you guys manage this asset for us? Because we just took it back from the borrower. They're foreclosing. Like, we have our president of ops is flying out to Dallas next week to go meet with one of our lenders because they're asking us to manage a deal that they're taking back at the end of May. And so that's the kind of stuff that you're seeing right now. And so we see it as a huge opportunity. Obviously it's unfortunate for a lot of groups, but now is the time, because a lot of the competition is on the sidelines. And one little anecdote I'll say here, Jeremy, and then I'll move on to whatever your next question is that a lot of people are saying, you keep hearing this this term, you don't want to catch a falling knife, right? Meaning we don't want to be buying until we know we're hitting the bottom. Well, historically, you never know what the bottom of any market or cycle is until it's in retrospect. And one big data point, which is an indicator to us that now is a good time and has been for at least the last 6-12 months, is that Blackstone, which is one of the largest owners of real estate in the world. The president of Blackstone just said, this was like 4 to 6 weeks ago. He says they think we've hit the bottom of pricing for real estate. They don't think it's going lower. And the next week after he said that, they announced that they were buying a $10 billion REIT, a real estate investment trust. It was their biggest transaction ever, all multifamily. And so if the big guys, the big money thinks now is a good time, what does that tell you? So we do think there may be a 6 to 12 month window here before that private equity is going to pour back in. It's mostly been on the sidelines since the summer of 22 when rates went up because of the volatility with interest rates. They didn't know where it was going to be, but it is starting to come back now. And so once the interest rates cut, the money flows back in, competition increases, values will go up very quickly.
Yeah, that makes sense. And I'd like to take this opportunity to transition, onto the track record. Really, we talk a lot about how important it is that the track record of the sponsor really does matter, right? But before we jump into your, Rise48's track record, over the course of the last several years, I'd really like to ask you one question before we do that, and that is, when you invest, you really have to invest with the end in mind, right? So based upon your experience, what does that typical buyer look like when the deal goes full cycle? You've renovated, 70, 80, 90% of the units, you get that whisper price from the local broker that says they have a potential buyer, of your fully renovated asset. What does typically the demographic of that buyer look like?
Yeah, good question. So most of our peers, Jeremy, like the buyers and sellers of these assets are large private equity companies. So they're hedge funds, they're life insurance companies, believe it or not, are one of the biggest owners of these real estate deals because they have so much cash from premiums that they have to park somewhere, and they want the tax efficiencies. They want safe, hard assets. And so, yeah, we've sold multiple deals to large publicly traded real estate investment trusts. We've also, we've bought a deal from like a politician's family office, kind of funny enough, who everybody would recognize. So like there's some private capital or, very wealthy families. And then there's, there are like, groups like us, but for the deals that we're buying, it's typically a little too big for most of the syndication groups. And so it's these large private equity firms. And the funny thing is that, most of our lenders are publicly traded REITs, real estate investment trusts that have what's called a debt fund, and they're loaning money to us for these deals. Well, these same groups also have equity arms. So a lot of our lenders are also our competition, like Starwood, for example. That's one of our lenders. The hotel company, most people don't realize they're one of the largest owners of multifamily in the entire country. I think they're like top 3, so those are the types of groups that are buying these deals.
No, that's great. Let's take this time then to jump into your track record. And then I know kind of shortly after this, we want to talk a little bit about the Charlotte expansion and why you like that market. And we can transition into the Q&A.
Okay, perfect. So real quick, guys, we purchased 51 deals. We've sold the first 11 that we've purchased. We've never done a capital call. And I mean, this is something that's become very common. So Jeremy mentioned distress. Capital call basically means that the sponsor, the operator, is asking the investor to put in additional money later on in the investment due to liquidity issues. This has become very common across the country, unfortunately, because of interest rates. We've never done one. We don't plan to do any. We've never lost investor money. We've never missed a debt service payment. All of our loans are in good standing. We've distributed over $119 million of cash back to investors to date. We do monthly investor reporting, and we do monthly investor distributions. So this means that you'll get a direct deposit hit your bank account first week of each month. I think a lot of groups will do quarterly reporting and quarterly distributions. We've always just done monthly because we feel like investors prefer that. Then here you see a track record. So these are project level returns. So we do what's called we're regulated by the SEC, okay? Because we raise money from passive investors, and we do what's called a 506B offering, B as in boy, which means that we cannot solicit our deals to the public. So like, Jeremy and Starting Point Capital do the same type of offering. And so we're also not able to solicit historical returns. So this is basically the project level return before the GP LP split. I can tell you that to kind of give you an idea, this is 11 different assets. So each one of these is a separate investment, with a separate set of investors. So 11 different projects on average. You can kind of see here from a projected return perspective, which is the light blue, we have an average down here. So we always do a very conservative risk-adjusted 5-year projection, okay? Because we have a 5-year stress test, which assumes that right after we buy the deal, there will immediately be some type of significant economic downturn or recession that hits where organic rent growth decreases significantly, vacancy increases. We can hold through the recession, execute the plan, and sell in year 5 to achieve the returns to the investor. So it's always a 5-year projection. And you can see here, we were projecting a 2.21 equity multiple initially over 5 years. This means that if you invested 100K for easy math, we gave you your 100K back plus 121K of profit. Okay, that's what that means. And then a 19% IRR over 5 years. And then you see the dark blue is actual returns. So these are the actual returns. So you've projected up front. We told investors we were going to get for each project and then what actually happened. In reality, you can see that the investment period was just under 18 months as compared to 5 years. The equity multiple was 2.53 in 18 months as compared to 2.21 in 60 months, which is 103% project level IRR. Now, again, this is project level. I can tell you that we've averaged to, if you're talking about the actual LP return or like the quote unquote take home return for the investor, we've averaged to more than double investor capital in these returns across 18 months. Now, obviously the market has been strong, right, during this time period, and we never projected this, right? We projected this. I've been telling investors for the last 2 years now, since the Fed drastically increased rates, hey, we're not going to be doubling your money in 18, 24 months anymore. Okay, we never projected it initially. We'll take it while we can, but we're typically trying to hit a 20% average annual return. Okay, so we're typically projecting to double your money over 5 years. Doubling your money is considered a 100% return. Okay, so 100% divided by 5 years is 20% per year. What that means is that if I can sell a deal in 2 years and give you your $100,000 back plus $40,000 of profit, that's considered a 1.4 equity multiple or a 40% return in 2 years. Okay, 40% divided by 2 years is 20% a year. If we can achieve that, we'll probably pull the trigger and sell. Okay, so that's what we're projecting typically is 20% average annual return. Now, with this said, we have not seen any other group across the country that were buying deals before us, after us, during the same time period that had these types of returns during the same time period. Okay, so this is really a combination of, sourcing most of these deals off market at a good basis from brokers, executing the value add plan, and then having internal thresholds of when to know to pull the trigger and sell deals. I personally know a lot of groups. I'm friends with guys that they could have sold deals at the same time as us and hit home runs, and they held on to them because they thought they could just keep climbing. For us, if we can lock in a return, we're going to pull the trigger, sell the deal, and then, like Jeremy said, do a 1031 exchange. And as an investor, you have the option to participate in the exchange or you can cash out. And so this just kind of shows you our historical track record is that we have gone full cycle through acquisition, executing of the plan, and selling the asset on 11 different deals. Now, this is an example of a past Starting Point Capital type of deal. Okay, so this is by investing through Jeremy and Starting Point Capital through his fund. This shows you the actual annual cash flows. Okay, so I know that the way that Starting Point Capital typically structures their deals is that the investor has what's called a 7% preferred return, and the preferred return is really designed to protect the passive investor, to ensure that you're getting 100% of your initial investment back first, plus 7% per year on that money before the sponsor, Starting Point Capital, makes any compensation. Okay, so you have to get all your money back plus 7% per year before you split. After those two events have occurred, you got all your money back plus 7%. It's then typically, and it may vary deal to deal, it typically is an 85-15 split, where 85% is going to you, the passive investor, 15% goes to the sponsor, Starting Point Capital. So we always have this slide in the investment decks that shows you, there would be a separate slide that shows you the structure I just explained, but this shows you actual cash flows years 1 through 5. Now, as an investor, you have a 7% preferred return, but these value add deals, they don't start out at 7% in year 1, okay? Because we're renovating units, turning the units over, and increasing the rent. So this shows you, it starts out at, and this is an example, if you were to invest 100K, typically it's a 50K minimum, but it's a 100K example for easy math. In this example, you're going to make 3.9% in year 1, and then you see it's trending up as we execute the business plan and increase those rents. So, this would, if you invested $100,000, this is what your annual cash flow looks like. You divide this number by 12, that's what your monthly distributions look like. Okay, so you have a 7% preferred return, and you're getting this cash flow each year. Once we sell, we have to give you your $100,000 back. I have to fully catch you up on the delta. So in this case, it would be 3.1% So whatever the difference between 7% is and what you're getting each year, we have to fully catch you up on that before the sponsor makes any compensation through cash flow or quote unquote sweat equity. So that's kind of how that
It's a cumulative return, right? Over the course of the hold period. And then of course, you guys are buying assets that are already cash flowing day one. Before anybody swings a hammer or renovates a unit, these are already cash flowing investments, which means that those distributions are really starting immediately.
That's right. That's right. So yeah, and that's, I mean, that's like the difference between this and like a development deal, right? Like a development deal, you're gonna buy it, you're gonna invest. There's no cash flow because it's being built, and then you're getting all this return on the back end. In this example, you invest $100,000, it's cash flowing day one. You're making $26,000 in cash flow over the life of the investment. Then we sell the deal, you get your $100,000 back plus $78,000 of profits upon the sale. So 78,000 plus 26,000 is 105,000. So this is basically you're getting your 100K back plus 105K of profit, which would be considered a 2.05 equity multiple, more than doubling your money. So this is always broken down. So these deals we tell people, I always tell people like, Jeremy said it's not get rich quick. I think that's a great slogan. I tell people this is not like a tech company or like an app. I'm not going to like 10x your money, but it also is a lot more conservative and insulated because it's cash flowing day one. So you're getting these solid returns over time. All right, now let's talk about North Carolina expansion. So we started in Phoenix. That's where our corporate office is. That's where I'm sitting right now. Vikram and I are both here in the Phoenix office. We have an office in Dallas, which we expanded to in 2022, and we recently just opened up an office in Charlotte, North Carolina. And so we're really excited about the Charlotte market. We've been wanting to enter Charlotte for a while now. It's just been so competitive, and we wanted to make sure we had the right infrastructure in that market. Okay, and so you can kind of see here some of the main reasons we like Charlotte. It's not rocket science when it comes down to the fundamentals that we're looking for in our markets. Okay, we're looking for population growth. We need people moving to that market because you need people who are going to live in these apartments, right? So we want to be in the top markets where people are moving to. And you can kind of see here, North Carolina is number 3 in the country now for population growth, which actually was shocking me when we started looking at this at the beginning of the year. It's Texas is number 1. Florida's number 2, North Carolina's number 3. Okay, so people are going there, heading there in droves. Charlotte is top 5 in the country for job growth. So we obviously want people moving there. We need these people to have jobs so that they can make money, pay their rent, which goes to you as an investor as cash flow. Okay, that's how this works. And so, they're top 5 in the country for job growth, and it's diversified job growth. Okay, we don't like markets that are heavily concentrated in one industry. Like we don't like Vegas, for example. And this is just our personal opinion. I'm not here to bash any market because some people have different opinions, but we always look at U.S. Bureau of Labor Statistics data, which shows us what is the concentration of the workforce based on industry. Okay, and so Charlotte has a very diversified workforce, meaning that it's not too heavily concentrated in any one market. Vegas, for example, heavily concentrated in hospitality and tourism. It got crushed during COVID. We don't like Houston because it's like 30% of the jobs roughly are oil and gas. And so we want to be in these markets that are very diversified and have a ton of big companies. I mean, you've got Bank of America has their national headquarters in Charlotte. You've got Lowe's, the home improvement store, has their national headquarters. Duke Energy is there. There's all these massive companies. And then we want to have strong median income with affordable rent. So we talked about, Jeremy asked, like, why do you like B-class housing? It's because it's more affordable, but we need to be in markets where people are making more money than the rents cost, okay? Because that allows us to increase the rent. And so whenever we're looking at not only a macro market, like Charlotte would be considered the macro, we are looking at specific micro submarkets in the Charlotte area, and we pull data. We pay thousands of dollars for different data and analytics from different companies that shows us the 1, the 3, and the 5 mile radius of median income. And so we're saying, okay, what are the people in this 1 mile radius making? How much money are they making on average? And this is all, U.S. Census Bureau, U.S. Bureau of Labor Statistics data. And then what are the rents in that area? And is it affordable? Because we always require that all of our tenants are making at least 2.5 to 3x the income of what the monthly rent is. Okay, that is our criteria. In addition to background check, credit check, no eviction history, et cetera. So we really like the the dynamics here where there's really strong jobs, strong median income, very affordable rents, and then landlord friendly. What does landlord friendly mean? Okay. And so I'm going to say this, it's maybe not politically correct, but we tell people we're an investment company at the end of the day. Okay. So regardless of your political affiliation, we have a fiduciary responsibility to protect and grow our investors' money. And the investment is this apartment building. So if somebody does not pay their rent, I need to be able to evict them in 30 to 40 days. I need to get them out of that apartment building so that it does not negatively impact the investment. We will never go to markets like California, Oregon State, Washington State, New York, where a lot of those, I mean, you can't evict people for 6 to 12 months in some of these markets. And so you have these people that will just not pay their rent. You can't evict them because of local legislation, and it completely destroys the investment because the lender doesn't care. You still have to pay your monthly mortgage payment to lender. You still have to pay the operating expenses. You got to pay your staff, but you have no money coming in. And so we have to be in landlord friendly states where we can evict people. We also have to be in states where we can non-renew people, meaning when their lease expires, it's not an eviction, but I can non-renew them and say, hey, your lease is expiring. We're not renewing you. We're sorry. You have to move out. You have to leave, because that's how we renovate these units. So we can demo it, renovate it, move in somebody else. Business friendly. We want to have business friendly states where they're pro growth. They're inviting new companies to come. You look at a contrast between a market like Phoenix and Tucson. We don't like Tucson because it's very anti-business. It's very progressive local legislation. And that's why there hasn't been a ton of growth there. For how close it is to Phoenix, it should have exploded, but there's like a university and healthcare. And so, Charlotte and this area is very business friendly, which is why you have all these big companies coming there. This goes to corporate tax rates, state income tax rates, all these different things are important. And then property taxes. And so, we really like the property tax structure. So Charlotte is located in Mecklenburg County. Property taxes are determined by the county. And in Mecklenburg County, in Charlotte, they reassess property taxes once every 4 years. So it's very predictable. Okay. And they just did it last year in 2023, which means it's not going to be reassessed until 2027. Whereas we love Dallas. Okay. We love Dallas, Texas. But one of the big challenges with Dallas is that they can reassess every year. And it's so arbitrary, it's hard to underwrite it. Whereas, here in Charlotte, it's a lot more predictable, kind of like Phoenix. And then insurance. So Bikram and I looked at every major market in the country when we decided what's going to be the third market. We scoured every market. We looked at all these factors and more, and it came down to Charlotte and Tampa, Florida. They're both very similar size, tops and job growth, population growth, et cetera. The challenge with Tampa and all the Florida markets is the insurance costs are so high, it kills the economics. It makes the deal very tough to work. The insurance is a lot lower in Charlotte, and it's a lot more predictable. It's not a coastal city. And so anyways, these are all the main reasons we really like this market. And we talked about Blackstone earlier, Jeremy. I mean, Blackstone's been the top buyer in Charlotte the last few years. So what does that tell you? You get to chase that big money. They know some stuff that we don't maybe. So that's the Charlotte. And now we can do the Q&A. So I don't know if you have questions, Jeremy, or
Yeah, we have a couple of investor questions here, so I'll kind of get started. One of them I think we already answered, and that was, when do the cash flow distributions, typically start? I would say they really start immediately, but typically that first, distribution is made, anywhere between 45 to 60 days, upon close of the sale. Another question: how do most investors, fund these deals? I would say the majority of our investors, are investing, using liquid cash, but we certainly have a good demographic of investors that are choosing to use IRA money through a self-directed IRA strategy. So if you want to learn more about that, just go ahead and reach out to me directly. We do certainly have some investors that from time to time choose to take some money off the table in Wall Street and liquidate stock. We do have investors that have executed a 1031 exchange strategy, a like-kind investment from an existing investment, into, one of our future investment opportunities. But, we also have people that borrow from their 401k. If they have an active 401k, maybe it allows for them to, borrow $50,000 from the 401k and they have to pay interest. But the good news is they're paying the interest right back to themselves. They're not paying it back to a bank. So we've certainly had that happen before. We have people that use whole term life insurance policies that they pull money, out of those policies to invest into our opportunities, which is really kind of the infinite banking type strategy where you can really use, the same investment, dollar more than once. I would say that probably the biggest, compounding win for these types of investments, which my wife and I, certainly participate in, is we receive, well in excess of six figures a year in monthly distributions that's directly deposited into our bank account. And what do we do with that money? Well, I can tell you, we're not spending it on date nights. We're reinvesting, that money back into other opportunities. So my wife and I can go into every brand new year and we can say, hey, we know we're going to make at least this amount of money this year in distributions, through the 29 deals that we're in today. And we're just redeploying that capital then into another one or two investment opportunities over the course of that year. Kind of an interesting example that I like to share with people oftentimes is what I call the Ford truck example. So my wife and I were faced a number of years ago to purchase a new Ford truck. We've got 4 kids. There's 2 of us. So there's 6 people, right? We can't get by with a small SUV. It's got to be a large one. So I looked at the sticker price and I said, well, interestingly enough, if I invest $100,000 of my money into a cash flowing real estate investment, that maybe year one, the distributions are going to start out at 4%, but they're kind of scale up from there. I wonder if instead of me purchasing that vehicle in cash, or instead of me purchasing that vehicle using some type of a debt structure, through the dealership, right? What if instead I took that $100,000 I invested into a passive real estate syndication that paid us 4 to 6%, cash on cash distribution with the tax benefits involved at the end, with the equity profit split that I receive when that deal goes full cycle. I wonder if I could strictly use my cash flow distributions on that investment to pay for the loan on the truck. Okay. So the only reason why I bring this example up is because there are creative ways that people have come to, mindset changes where they choose to invest passively into our real estate opportunities. And that's really something that every person, needs to really look inward and determine, what your appetite is for risk, what maybe types of mental, I've always invested this way because my financial advisor tells me to do it this way. Maybe there are other ways, that you could take control, of your wealth building strategy. So another question here from the audience is, what entity do investors typically invest under? I would say the majority of our investors are either investing as individuals, joint ownership. They might invest in a trust. Some obviously use the self-directed IRA strategy and invest, under that type of an entity. And I'd say the smallest percentage of our investors, will actually invest, under an entity like an LLC or something of that nature. One question that we have, and maybe Bikram, you can help answer this, but I'll kind of, give it my best chance here. But an investor asks, what is the typical passive depreciation loss to the investor, the LP investor in year one? I know there's bonus depreciation rules in place, today that have now been, decelerated down to 60%. But I think, 2024 investments typically will produce maybe a 40 to 50%, maybe 40 to 60%, passive paper loss depreciation in year one of the investment. Am I kind of getting that correct?
Yeah, we typically tell investors, thanks, Jeremy. We typically tell investors between 30 to 50% just to be on the conservative side. There's a lot of levers that go into it, right? If you have higher leverage, then you can get more depreciation loss because you have less equity going into the deal. Or, if we're raising a lot more reserves, then it dilutes the equity a little bit more. But typically around 30 to 50% is a good number to aim for.
Great. Thank you. Getting a lot of questions about the Charlotte market and kind of what's coming up there. Please reach out to me directly if you'd like to learn more. because we have individuals on this call today that do not have a direct relationship with myself or Zach or Bikron, we need to follow Regulation D 506B rules according to the SEC. So we're not allowed on this particular call to have those in-depth conversations about potential opportunities unless you have a pre-existing relationship with myself or somebody on the Rise48 team. So good questions there. I don't see any other questions outside of that. I did want to at least take the opportunity to let people know how they can get a hold of myself. I consider Starting Point Capital to really be an extension of Rise48's effort in partnering with investors. We take our relationship with not only Rise48, but also our investor community very seriously. So if there are any additional questions, please don't hesitate to reach out. You can find my contact information and more information about Starting Point Capital at startingpointcapital.com. You can also email me directly at jeremy@startingpointcapital.com. I also host a podcast that produces 2 episodes per week. You're welcome to check out some of what our guests have been saying, as well as myself. The name of the podcast is called The Freedom Point. We're on YouTube as well as all major podcasting stations. And then also, you heard it here first, I'm in the process of writing a book on passive real estate investing. It's literally the number one thing that most of our investor community says to me, and that is, Jeremy, you need to bottle all this up in a book. Okay. So I took the opportunity upon myself to say 2024 is the year that Jeremy is going to author a book. So be on the lookout for that. The title is not yet going to be released. So I will certainly let folks know when that book is ready to be published sometime in probably the fall of 2024.
Is there a promo code to get an autographed copy of the book, Jeremy?
I will happily send an autographed copy to anybody upon request, Zach, including yourself.
Okay, perfect. All right. That's what I'm talking about.
Well, outside of that, Zach and Bikron, really appreciate both of you guys jumping on the call today. Certainly appreciate your support and help and all the different ways that you guys provide our investor base with that support. And with that, we're all done.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.